Section 3.3 Understanding Standard Deviation. 3.3 Standard Deviation as a risk measure. Standard deviation is a useful tool for assessing the risk of individual securities and investment strategies. Here's how standard deviation can be employed to evaluate risk in these contexts. Individual securities. Standard deviation helps measure the volatility or price fluctuations of individual securities. By analyzing the standard deviation of a security's historical returns, investors can gain insights into its risk profile. Here's how it is used. A. Risk assessment. A higher standard deviation suggests greater price volatility and higher risk for the security. Securities with high standard deviations are considered more volatile and may experience larger and more frequent price swings. Conversely, securities with low standard deviations are typically seen as less risky due to their relative stability. B. Risk comparison. Standard deviation allows for the comparison of risk across different securities. By comparing the standard deviations of various securities, investors can evaluate and rank their risk levels. This comparison helps investors make informed decisions and choose securities that align with their risk tolerance and investment objectives. C. Risk-return trade-off. Standard deviation plays a role in assessing the risk-return trade-off of individual securities. Generally, securities with higher standard deviations have the potential for higher returns, but they also carry higher risk. Investors need to evaluate whether the potential return justifies the level of risk associated with the security. Investment strategies. Standard deviation is also applicable to assessing the risk of investment strategies. Whether it's a diversified portfolio, an active trading strategy, or a passive investment approach, standard deviation helps evaluate the risk associated with the strategy. Here's how it is utilized. A. Portfolio risk. For a portfolio or investment strategy, standard deviation measures the overall risk by considering the collective volatility of the underlying securities. It helps investors understand the potential range of returns and assess the strategy's risk level. Higher standard deviations indicate greater portfolio volatility and potentially higher risk. B. Risk management. Standard deviation aids in risk management by helping investors set risk targets and establish risk control measures. By monitoring the standard deviation of a portfolio or strategy, investors can assess if the risk is within their desired range and take appropriate actions to mitigate risk when necessary. C. Strategy comparison. Standard deviation allows for the comparison of risk across different investment strategies. Investors can evaluate the standard deviations of various strategies to understand their risk profiles. This comparison helps in selecting strategies that align with an investor's risk tolerance. Investment goals and time horizon. It's important to note that standard deviation is just one measure of risk, and it has limitations. It assumes a normal distribution of returns, which may not always hold true, particularly during periods of market stress or extreme events. Other risk measures, such as downside risk or value at risk, VaR, can complement standard deviation analysis to provide a more comprehensive assessment of risk. In summary, standard deviation is a valuable tool for assessing the risk of individual securities and investment strategies. It aids in risk assessment, risk comparison, evaluating the risk-return trade-off, managing risk, and comparing strategies. However, it should be used in conjunction with other risk measures and with a thorough understanding of its limitations. Comparing and evaluating investment options based on their standard deviations can provide insights into the risk profiles of different investments. Here's how you can use standard deviation to compare and evaluate investment options. Gather standard deviation data. Obtain the historical or expected returns for each investment option and calculate their respective standard deviations. The standard deviation represents the volatility or risk of each investment. Consider risk tolerance. Assess your risk tolerance and investment objectives. Determine the level of risk you are comfortable with and the specific goals you want to achieve. Evaluate standard deviations. Compare the standard deviations of the investment options. A higher standard deviation indicates higher volatility and potentially higher risk, while a lower standard deviation suggests lower volatility and potentially lower risk. Risk-return trade-off. Consider the relationship between risk and return. Typically, investments with higher standard deviations also offer the potential for higher returns, reflecting the risk-return trade-off. Evaluate whether the expected returns of the investment options align with the level of risk you are willing to accept. Diversification. Assess the potential benefits of diversification. If you are considering multiple investment options, evaluate how their standard deviations interact. Combining investments with low or negative correlations can reduce overall portfolio risk. Diversification allows for a more balanced risk exposure and can potentially enhance risk-adjusted returns. Consider investment time horizon. Take into account your investment time horizon. Investments with higher standard deviations may be more suitable for long-term investment horizons, where there is more time to potentially recover from short-term volatility. On the other hand, investments with lower standard deviations may be more appropriate for shorter-term investment goals or a more conservative risk approach. Additional risk measures. Consider using other risk measures in conjunction with standard deviation. Value at risk, VAR, downside risk, or other risk metrics can provide a more comprehensive assessment of the potential downside risk and extreme events. Seek professional advice. If you are unsure about evaluating investment options based on standard deviation or other risk measures, consider seeking advice from a financial advisor or investment professional. They can provide personalized guidance based on your specific financial situation and objectives. Remember that standard deviation is just one measure of risk, and it has limitations. It assumes a normal distribution of returns, which may not always hold true. It's important to conduct a thorough analysis, consider other risk factors, and align your investment choices with your risk tolerance and goals. In summary, comparing investment options based on their standard deviations helps evaluate their risk profiles. Consider risk tolerance, the risk-return trade-off, diversification benefits, investment time horizon, and other risk measures to make informed investment decisions.